Hello, ladies and gentlemen. For over 20 years, I have spent a lot of my free time trying to figure out what it takes to become a successful trader. I've read all sorts of books about trading. I have read all sorts of internet forum posts, and who knows how much time I've spent on YouTube watching videos about financial trading and speculation. Consequently, I would now like to share with you a few habits which, in my personal opinion, virtually all successful traders have. And the first habit I would like to discuss involves ignoring the mainstream media. Successful traders as a whole are not regular consumers of the mainstream media. There are several reasons for this. Firstly, the mainstream media is more geared towards either shocking their audience or entertaining their audience or providing their audience with a narrative that they already believe. So it's safe to assume that good traders distrust the mainstream media. But there's only one thing that smart traders distrust more than the mainstream media, and that's the financial media. Now, look, I've watched more than my fair share of Bloomberg and CNBC, and I've got nothing against the people who work at these fine institutions. But I cannot fathom how any serious trader can develop a logical and coherent trade idea based on the random intellectual musings of a talking head on the television. So, if you would like to become a successful trader, then you need to get in a habit of ignoring the mainstream media and ignoring the financial media. This habit will probably, well, almost most definitely improve the quality of your thinking, and it will probably improve your mental health as well. Okay, the next habit I would like to discuss involves the use of journals. All great traders maintain detailed trading journals. A well maintained trading journal will contain more valuable lessons and insights than any book, course, or YouTube video. Provided that, number one, you write in your journal frequently, and number two, you review your trading journal frequently. So, what should you write about in your trading journal? Well, write about whatever you like. I think that this is a case of what you write is less important than how frequently you write in your journal. But if you would like your trading journal to be of any real use to you, then you need to write about things such as the systems you will put in place in order to generate trade ideas, market events that you've had to deal with, IT issues, how your personal life is affecting your trading, as well as your review notes for when you review your trading performance, let's say sort of every month or every quarter. Now, if you are involved in short term trading, then after every trading session, you could use a simple notebook, such as something like this, to write about things such as what you did well, ideas you plan to implement to improve your trading performance, and you might even want to include the printout of your charts. Because this will help to develop your trader intuition, if you will. The next habit I would like to discuss pertains to the fact that successful traders don't really process information in a binary way. They're more accustomed to dealing with shades of grey. Successful traders know how to measure, compile, and interpret lots of different variables, such as economic data, in order to generate good trading decisions that are nuanced and well balanced. For smart traders, their risk exposure to any given trade idea is directly proportional to the perceived probability of success. In other words, good traders understand that not all trade ideas are created equal, and they know how to deal with this fact of financial trading and speculation. The next habit I would like to discuss is more of a mindset habit, and it relates to the concept of self-expression. Allow me to explain. For successful traders, their trading account is an extension of, number one, their personalities, and number two, their views about the future. In other words, trading ultimately is a form of self-expression. Now, at this point, I would now like to share with you a few words of wisdom from the legendary martial artist Bruce Lee. The quote that I'm about to share with you, I think it originates from an interview that Bruce Lee gave on the Pierre Berton show in 1971. I will leave a link to the video clip of the quote down below. The quote is as follows, and you have to excuse me because I'll need to refer to my computer tablet. Quote, honestly, expressing yourself, it is difficult to do. I mean, it is easy for me to put on a show and be cocky and be flooded with a cocky feeling and then feel pretty cool. Or I can make all kind of phony things, you see what I mean, blinded by it. Or I can show you some really fancy movement. But to express oneself honestly, not lying to oneself, that, my friend, is very hard to do. End of quote. So, for instance, right now on the internet, there's a lot of discussion about whether or not technical analysis works. Now, if you genuinely believe that technical analysis has the capability to predict future price behavior for any given market, then by all means, go ahead and use it. But if you're a bit like me and you get a little bit annoyed and frustrated with technical analysis, then you need to find something that is a better fit for your psychological makeup. Because the easiest way to destroy yourself as a trader is to trade in a way that is not in line with your own personal psychology. The next habit I would like to discuss involves the use of market narratives, or narratives for short. Successful traders know how to think in terms of narratives. And a narrative is basically a story concerning a security or an asset that's also the focal point of investors. For instance, back when Netflix was a young startup company, the narrative of the company was in relation to the fact that the business was able to get lots of new subscribers very, very quickly at a low cost. Now that Netflix is a mature company, the narrative is in relation to A, how the company plans to retain their subscribers, and B, how the company plans to turn subscriber revenue into investor dividends. Good traders always understand the prevailing market narrative, even if they don't agree with it. But above all else, smart traders understand that narratives change. And in fact, when narrative change, this represents exciting trading opportunities. But you've got to have some sort of catalyst for this change. And this catalyst can either be in the form of a single event, such as an earnings report, or a gradual change in circumstances. For example, a shift of focus for central bankers. The next habit I would like to discuss is in relation to how we talk about price changes within the market. Successful traders talk about price changes in terms of percentages, not pips. This is important because percentages allow us to differentiate between significant price changes and insignificant price changes. Allow me to explain with a simple hypothetical scenario. Suppose that in 1 year you have two stocks. You have stock A that goes from $10 to $15, and stock B that goes from, say, $100 to $120. So stock A has gone up by $5 and stock B has gone up by $20. Now, in absolute terms, the price change of stock B is more significant than the price change of stock A. However, in percentage terms, and in terms that matter most to traders, particularly if they're trading on leverage, stock A has gone up by 50%, whereas stock B has gone up by 20%. Therefore, the price change of stock A is more significant than the price change of stock B. Now, if you're going to use percentages to talk about price changes, there is a little caveat, and this is a little pet peeve of mine. Whenever you talk about price change percentages, you've got to include some sort of time frame. For instance, you'll hear financial journalists say something silly like stock XYZ has lost 10% of its value. Well, what does that mean? What, has it lost 10% of its value in the past week, the past month, the past year, the past decade? You see where I'm going with this. So when talking about price changes, talk in terms of percentages, and please include some sort of time frame. The last habit I would like to discuss involves the use of stop loss orders. Now, all successful traders use stop loss orders, but here's the thing: a stop loss is a last nine. No, let me put it another way: a stop loss is a last resort. It's not a first line of defense. This is important because successful traders work very hard to keep their trading losses as tiny as possible. This is because that whenever you trade at any given time, there's a 70% chance that you will be in a drawdown. Now, unfortunately, there isn't much we can do to change that percentage, but we can work hard to keep the size of our drawdowns as small as possible. Therefore, as traders, we must get in a habit of being patient with our winners and being impatient with our losers. Conclusion. I hope this video will help you to develop the type of habits that will improve your trading performance. But if you would like a few more ideas that could help you improve your trading performance, please feel free to have a look at my video titled How to Become an intelligent trader and investor. I will leave a link to the video down below. Thank you for your time and happy trading.